just a quick reminder that SEC listed back in December of 2017. We raised $132 million on the ASX. We've been very pleased to have Spheria as part of the Pinnacle boutique for about 3 years now. Is that right?
Coming up to 3 years, Conor.
3 years, yep. We've soft closed the micro strategy. The smaller companies fund is got relatively limited capacity left, and the inflows have been pretty strong, which I think is a good recognition of Matt, Marcus, and the rest of the team at Spheria. So I'll hand over to Matt to bring you through some of the performance backgrounds, a bit more on the company itself, and then we'll touch on some of the portfolio as we go through it too.
Okay, thank you, Conor. Just talking about performance since we listed the company, it has been a pretty bullish market till the last few months, and it has been a pretty difficult environment. We are very, very valuation focused in what we do, so we did lag for a big chunk of the period, but what we've seen in the last few months is we're outperforming. Not much of solace because obviously the markets are deteriorating, but we're holding up better than most. The reason for that is we are seeing some takeover activity in our portfolios. So we've had some of the larger positions bid for and some of the smaller positions as well. So it feels like the market is more focused on valuation now, whereas before it was focused on momentum. And momentum markets are difficult for us to traverse given our valuation processes in place. But we're starting to see that convergence now. So we're starting to see some improved performance, and we're finding some good ideas, and we think there'll be more good idea generation over the next few months as things do wash out, particularly some of the growthier names that basically got overvalued. In terms of the company overview, so there are 3 board members. The Spheria team's not on the board. We've got enough duties to do in terms of running money, and we want to focus on running money. The market capitalisation is about $120 million at $1.80. The NTA is currently around $2, so it's trading at a pretty sharp discount. So there's a valuation opportunity in the LIC. We have a pretty diversified portfolio, which I'll talk about later, but it is holding up reasonably well despite difficult markets. In terms of dividends, we want to maintain a steady dividend stream, so we're only paying dividends out of dividends that accrue in the portfolio. We're not paying out any capital gains. That may change if there's any change to the franking credit status under a new government, but at this point in time, we're just paying out dividends out of dividends that are accruing, so it's very sustainable. I know that some LICs pay out all of the capital gains as well as the dividends. We're just trying to have a sustainable policy on that front. In terms of performance since we listed, you can see that the NTA, so that's after all costs and tax, etc., is up a little bit since we listed when you add back the dividend, which is pretty good performance because obviously there's been a big downdraft recently. The share price has underperformed. I think you've seen most of the LICs underperform during this period. I think we're holding up reasonably well, but there is a discount there which, as I said before, affords people an opportunity to invest in basically what is our small cap product as a listed entity. So you can go into the managed fund and you pay par, or you can buy the LIC on the market and pay a discount. Some of the clients are obviously buying the LIC because it's cheaper. So that's a good thing. In terms of communications, I'll pass over to Conor, but we are increasing frequency of communications and we want to improve the marketing side of things so we get more interest in the company.
Yep, so just from a Pinnacle point of view, we're pretty focused on making sure investors have good outcomes in all of our listed strategies. We clearly have plans to do more in the future, and if people don't have good experiences what they've invested in the past, then they're not going to invest in anything we do going forward. So a few of the things we're looking to do is increase the commentary and frequency in the newsletters. If you look at the open rates on the listed monthly newsletter, we get click-through rates of around 60%, which is incredible when you usually compare that to a fund open rate of around 15%. So clearly investors want more information from us, which we're going to be providing them. We're moving to video updates so people can hear from Matt and Marcus and the portfolio management team on a regular basis about what is going on in the market, which you'll be able to provide to clients as well. We're opening up quarterly dedicated LIC webinars, which we'll also invite the direct investor to. where the guys will touch on the portfolio, but everyone will get an opportunity just to ask questions to any member of the team as we do them. We're aware that we need to increase our brand awareness and reputation in Pinnacle. We are a listed house these days, and we want to make sure that as we continue to do things that we're at the front of the market, and definitely seen as best in class from a listed point of view. And just broadly, look, we are aware that, as Matt said, that the LIC market has moved to more of a discount over the last couple of months, but by no means is that an excuse to sit on your laurels and just say, well, that's a good enough reason for SEC to be trading at a discount. We want to make sure that people have good experiences in the strategies, as I said. And so with this communications plan, we're having a big mobilization of our Pinnacle distribution team, which is now 25 people. It's quite substantial. And also looking at buying shares on market as well, potentially down the track. So we're hoping that it's not going to happen overnight, but we're very focused on making sure that the gap to NTA is closed in the medium term.
Back to portfolio performance again. You can see the relative performance since inception, so that's nearly 12 months, and the performance over shorter time horizons has been pretty strong. That is after all costs as well, so that's all the holding company costs, all tax, etc. So the actual portfolio has been operating pretty well given the dilution that you get from some of those costs. And we do think there's some good opportunities in the market, and we'll ride this out, and we think it'll come out the other side stronger. In terms of our philosophy, for those people who don't know how we invest, we're very fundamental focused, and what we focus on is free cash flow generation. We believe that every company is simply worth the present value of future free cash flow. So we don't get stuck on EBITDA or other nomenclature. We try and cut through to the cash flow statement and work out what a company can sustainably generate in terms of cash flow. And that's after all CapEx. So there's plenty of companies out there that generate EBITDA, but they spend a lot of money to get there. So we're very focused on returns, and we're very focused on valuation, and we think that holds us in pretty good stead going forward. Also, balance sheets are important to us. We don't just look at the balance sheet per se, we look at all the off-balance sheet leases. So we make sure we adjust for that and compare across the universe, including leases. So we look at fixed charge cover to just make sure there's not too much risk in a business. And so we believe that eliminates some of that risk in that small cap space. We're not buying some of the more risky balance sheets out there effectively. And at the moment, I think retail's probably on the nose a bit, and that's where there is a lot of risk with operating leases. So just an example of what we try and consistently calculate across sectors and across companies. In terms of the investment team, so you got Marcus and myself, who are the co-PMs on all the strategies. We've got a good team beneath us. So we've got Adam Lund and Olivia Coulon. Olivia had 12 years at Pendle Group, so he's well known in the market. He's pretty much an encyclopedia on small caps and micro caps, so he's been a fantastic addition for the last 11 months or so. And he's fitted in really well. Philosophically, he's very aligned with what we do. Gino Rossi's recently joined us. He's a very experienced small cap investor. He's going to focus more on the mid cap stuff for us, so he's focusing more on mid cap universe, and we think he'll be a good addition. We are trying to build out our mid-cap strategy, which only has $20 million in it at the moment. And Al Dockey joined us. He joined us to take some weight off Adam. Adam's doing a lot of research, trading, and administration, and Al does a lot of the grunt work for Adam. So Al is a very sensible person, very skeptical, so he's a good dealer, which is what we need. In terms of process, and you probably haven't seen this slide before, we say we focus on quality businesses, but what makes a quality business? We try and get under the bonnet of a business and look at the industry structure, what sort of share the company has, and what we believe the free cash flow can be sustained through the cycle. As I said before, we have a valuation model which is consistent for the whole team. We all use the same template, so the input, the output can all be assessed by team members on the same basis. We have an automatic model, so we populate all the history of our data for each company from a third-party supplier, and that provider provides financial statements on a half-yearly and full-year basis, and they provide it to us on a timely basis, so we just hit a button and it updates. So a company reports on a Thursday, the data's in there overnight, and we are basically using that data the next day. So it's a very efficient, proficient model, and it allows us to assess companies pretty quickly. Obviously, going forward, we need to forecast a company's cash flow, and that's where you do get some subjectiveness. But all the historic data is all objective. We always say that we need to keep an open mind. We don't just write companies off because we don't agree with them. Often there's changes in companies, whether the industry changes or management changes, and that provides an opportunity. There's inflection points in companies, and just because a company's written off doesn't mean it's not an opportunity. And on the other flip side of that, we also keep an eye on companies that are doing well. And, we will buy high quality companies where we believe there's predictable earnings and the valuation's not too stretched. So we do go from value to growth. At the moment, we're more value biased, which I think has afforded us quite significant protection in these markets. We do think the market's under-researched and it's very inefficient outside of the larger companies, which, with our engine in terms of our modelling, our model, and the team that we've got, we think we can cover a lot of ground quickly. So we do cover the ground effectively and very quickly. And I think we do a really good job. I think anyone who comes through and sees the models that we put together and looks at the thinking behind it understands that we do a lot of analytical work on the companies, probably a lot more than some of our peers. In terms of portfolio construction, we have a pretty simple wheel chart. Valuation is obviously a focus for us, but we also focus on risk as well. And I discussed risk before. We manage risk in the portfolio through different weightings. So if it's a core holding, it has a low risk balance sheet. We can have a bigger weighting in it, and that usually means it's a net cash balance sheet, or it has minimal debt, or it has cash flow to cover that debt. A satellite position generally has a weaker balance sheet and has cash flow to cover the balance sheet, but it is a bit more stretched. So that will be a smaller position in the portfolio. We also limit sizes of stocks in the fund. So we have a 5% cap on each stock, so we don't get too concentrated in any one name. I know other managers do get more concentrated. We just believe that diversification does give us some protection because we are going to make mistakes in the portfolio. We're not perfect in what we do. Liquidity is also important. We can have the best name, but if we can't get liquidity, then it's an issue. So the sizing of the position is limited by the liquidity in the stock. We also consider tax, and we value franking credits in our model. So our valuations include franking credits on balance sheet and a value for the streamed franking credits that come through from that company. So we consider quite a few things in our construction process. In terms of our dashboard, and I think this is Certex, which is this is basically on our template. So we have a dashboard with a risk scorecard and a valuation scorecard. We also pump out those automatic charts. So those are 2 of the 6 charts that we produce, probably 2 of the key charts. The other charts are returns, capex, and some other charts on multiples, etc. But you can see the cash flow conversion chart is pretty critical for us. So that top left one, and what we're measuring there is the free cash flow before tax and interest, and we're comparing it to the EBIT. So it should be an apples for apples comparison. This is Certex. So Certex was going through some trials years ago, and they were spending more capex that exceeded their amortization. Hence, their cash flow was less than their EBIT for a while. What we saw was the trials ended. Obviously, the trials didn't end the way they wanted them to end, but they did end. And when they ended, the cash flow actually started to exceed the EBIT. So you started to see good, strong cash flow generation out of the business. So that's our first quality filter on a company, is just cash flow conversion. We look at returns and margins within that, and the margins for this business are quite sustainable. So it's all about volume growth. Now, what we saw in this company was a net cash balance sheet, so it ticked all the risk boxes. We saw a duopoly market structure, so we do a Porter analysis of the industry, and we believe there was a duopoly structure and there was going to be greater penetration for the spherical treatment post the trials completing. Despite the trials not living up to what people's expectations were, they still were fairly positive. And we thought that over time the US market would adopt the spherical treatment. So it would go from a penetration rate of mid-single digit to much higher levels. And with that volume growth, Certex was going to grow its earnings quite substantially. So we found a company here that we thought was a growth company, a big addressable market, low penetration, duopoly market, and it effectively was trading at a value multiple. So it was a company we bought in first around $12. Subsequent to that, it was bid for by 2 companies and ended up being bought out for $33.60. We exited at $29 because the last bid was from a Chinese private equity group, and we thought the bid was a bit fragile, but we did make a lot of money for our clients out of this one. In terms of the process, just wrapping another company into it, Technology One is a company that we followed for a number of years. You can see the cash flow conversion chart on the left there. It's a fantastic cash flow producer, has been for its 20 plus years of existence. The business is growing, it's winning market share in the verticals it operates in. It's beating the big guys, SAP, Oracle and Microsoft. It's got better software, it's got a better overall solution than its competitors. It has over 300 councils in Australia on the system. I think there's only 540 councils in Australia, so there has been significant penetration by Technology One. We think they will continue to take share in that vertical, but it is maturing. Where we think the big growth for the company is in the UK. We think that market could be quite similar to the Australian market, so there's significant potential growth over here. In addition, the company's revenue streams are becoming more predictable, so they're getting more SaaS, more recurring revenue out of the business, which means we think it's a higher multiple business. But what happened 6 months ago is the company actually derated. You can see on the next chart, you look at the EV to EBIT, so it derated pretty aggressively. It was trading at nearly 40 times EBIT. It traded back down to 20 times EBIT. It's a 5% free cash flow yield. We thought that was pretty attractive earlier in the year, and we thought some of the issues were quite temporary, so we bought into the company from $4.60 down to, I think it got down to nearly $4. I think the average price we paid was about $4.40. So we took a rather big position in the company as we believe the quality of the business is actually improving. If you look back through the history of the company, it actually has got expensive in the past as well. So the chart on the right, if you go back to the .com days, the stock traded right up. It got up to 50, 60 times EBIT and traded at around $1.50 back in 2000. So it got overbought. It was overly priced. And it actually delivered on the growth that everyone expected, but the stock derated. So it actually fell 80% during that period from 2000 through to 2003. It actually took 12 years to recover that share price loss. So it's amazing. I think the price you paid is important, and that's what we always say, that valuation does matter, and I think we're finding that out at the moment as some of those momentum strategies unwind. In terms of portfolio positioning, just looking at the top 5 holdings, Navitas is our biggest holding. We've owned that for a couple of years. We bought more in the last 6 months, and now it's subject to takeover. It's trading around $5, so it's trading a pretty sharp discount to the actual bid. We believe there is a process underway, and there'll be other bidders for the company. There's a New Zealand asset that sold recently that manages pathway programs and schools, etc., through Asia, and that business sold for 17 times EBITDA to a trade buyer called Inspire. And if you put 17 times EBITDA on Navitas, you get $7. So we believe that process in New Zealand had 5 trade buyers. So we suspect there'll be other buyers for Navitas. We don't think BGH is alone there. I think there's other strategic buyers of the business. I think the board has bought some time so they can negotiate a better price with other suitors. Bega Cheese is a company we've held for a long time. We like the outlook for the company. We think the industry is rationalising. We think they've bought well. We think the Mondelez assets have significant upside, particularly Vegemite. Vegemite earns about $40 million of EBIT, so it's a strong producer. It's got about $120 million of sales. We believe they can pull the price lever there quite significantly. If they added 20% to the price of a jar of Vegemite, I don't think it would affect end volumes, and that would be incremental to the bottom line. So we think there's a lot of upside in that acquisition, plus Koroit as well, which they bought from Murray Goulburn Saputo. They're already filling that up. So they bought pretty well. The existing core business is very stable, generates a decent return. So we do like the long-term outlook for that, particularly as the industry rationalises. We own Fletcher Building. We probably got in a bit early there. We're not concerned about the construction losses. We believe they're well provisioned for. However, the cycle is obviously deteriorating in Australia. New Zealand's holding up for now, but there is some risk around cycle. We believe that the actual business is quite well positioned from a balance sheet perspective, particularly if they sell Formica. If they sell Formica from anywhere from 1 to 1.5 billion, the company won't have any debt. So we're quite positive on the balance sheet, the potential balance sheet strength there, and the potential turnaround over time. We think it is a good restructuring type story. We also own Platinum, which we believe is positively exposed to the Asian economies. Going up through Asia, you get pretty excited going up through those markets, how sophisticated they are. And I think Platinum's well positioned to generate good returns over time out of those markets, and we think they're a good manager. So overall, we're pretty positive on the outlook for our portfolio. The momentum trade is unwinding. We won't be immune to the volatility, but we tend to buy cash flow generative businesses. We do care what we pay for these businesses, and the balance sheets are pretty strong. So we think we'll come through the other side. We think there'll be further takeover activity in the portfolio. As you saw that today, we own TradeMe, and that's subject to a takeover as well. So hopefully we get some more of those. It's always good when the market's falling. But, I'll wind it up there.